$38 trillion. The United States national debt hasn't just crossed a red line, it has entered terminal velocity. We are adding $2.4 trillion to the ledger every single year. That is not a statistic, that is a mathematical impossibility. President Trump offers a solution: tariffs, a wall of taxes on China, Mexico, Canada, and Europe. He promises a tariff dividend, a check for $2,000 in every American mailbox. But the math is not just optimistic, it is delusional. Even if we taxed every shipping container entering our ports at maximum rates, the Congressional Budget Office estimates we might squeeze out $500 billion. The annual deficit is $2.4 trillion. Do the arithmetic. Tariffs cannot even cover the interest on our credit card, let alone pay down the principal. Yet, Wall Street is dancing on the volcano. The S&P 500 sits at 6,640, an all-time high. Major banks are chasing the momentum. Barclays calls for 7,400 by 2026. Morgan Stanley is projecting numbers near 7,800. Bitcoin is knocking on the door of $100,000. Investors are drunk on the promise of deregulation and tax cuts, but they are missing the avalanche hanging directly above their heads. Gold knows. At $4,050 an ounce, gold is screaming what the stock market refuses to hear. The year 2026 will not be a boom. It will be the year the mathematics finally break the market. We are staring at a crash that will make 1929 look like a gentle correction, from 6,600 to 3,400, from Bitcoin dominance to digital dust. This is not politics. This is the end of an economic era. Most people are walking blindly into a slaughter. They think Donald Trump will wave a magic wand of tariffs and business-friendly policies to fix a broken system. They are wrong. Let me show you exactly why 2026 and 2027 will see the worst market crash since 1929. We are looking at a mathematical inevitability where the S&P 500 falls from 6,600 to below 3,400. We will see Bitcoin collapse from 100,000 to under 20,000. We will see the United States dollar lose its reserve currency status. This is not politics, this is arithmetic, and the math starts with the debt. Everything breaks from here. $38 trillion. That places our national debt at 136% of GDP. The only other time in history it was this high was right after World War II. But there is a massive, fatal difference. In 1946, America was the manufacturing engine of the globe. We had a young, exploding population, and interest rates were manipulated to stay near zero. We grew our way out because we produced real value. Today, our manufacturing base is gone. Our population is aging. Baby boomers are retiring en masse, and interest rates are nowhere near zero. They are 5% above. This changes the equation entirely. In fiscal year 2024, the U.S. government paid over $1 trillion just in interest on the debt. $1 trillion, that is more than the entire defense budget. It is more than Medicare. It is the second largest line item in the federal budget, trailing only Social Security, and it is growing exponentially. This is the trap. We borrow $2.4 trillion more than we collect in taxes every year just to keep the lights on. So the debt grows from $38 trillion to over $40 trillion in 2026. By 2030, it hits $50 trillion. Interest costs alone will reach $1.5 trillion per year. That means 20% of every tax dollar collected will go solely to paying interest to bondholders. Not for roads, not for schools, not for the military, just to service the debt. This is a death spiral. There are only three ways out. First, grow the economy faster than the debt impossible when tariffs are shrinking trade. Second, inflate away the debt print money until the dollar is worthless and everyone is poor. Third, default refuse to pay and crash the global financial system. None of these are good options. All of them end in catastrophe. Trump says tariffs will pay down the debt. Let me show you why that is economically impossible and financially suicidal. President Trump says tariffs will pay down the national debt. Let me show you why this is not just economically impossible, it is financially suicidal. The United States imports about $4 trillion in goods per year. Trump has proposed 60% tariffs on China, 25% on Mexico and Canada, and a baseline 10 to 20% on everything else. Let's assume he actually does it. Let's assume he taxes every single container entering American ports. The Congressional Budget Office has run the numbers. They estimate these tariffs would generate about $250 billion per year. That sounds like a fortune, until you look at the bill we have to pay. The annual deficit is $2.4 trillion. Tariff revenue covers barely 10% of the deficit. It does not pay down a single penny of the $38 trillion debt. It doesn't even slow the bleeding. It is a rounding error in a bankruptcy proceeding. But it gets worse. Trump is promising a tariff dividend, a $2,000 check to every American family. The Yale Budget Lab estimates the cost of this payout at $450 billion per year. Do the math. You collect $250 billion in tariffs. You pay out $450 billion in dividends. You are not reducing the debt. You are increasing the deficit by another $200 billion. You are trying to put out a forest fire with a bucket of gasoline. And tariffs are not free money. They are taxes on imports. When costs spike, import volumes collapse. Companies stop buying. Revenue falls. And then comes the retaliation. China strikes back at American farmers. Europe targets American tech. Exports crash. Economic growth stalls. Tax revenues plummet. The net impact on the deficit isn't positive. It is catastrophic. Tariffs cause inflation. The Fed cannot cut rates because prices are spiking. The economy tips into recession. This is why every credible economist screams that this plan is insane. But Trump believes he is smarter than the math. And for now, the market believes him too. Before we dissect the anatomy of the coming collapse, consider joining the channel membership. Inside, I do not offer hope. I offer maps through the minefield. I break down every liquidity signal and credit stress indicator that the mainstream media ignores until the explosion makes the headlines. This is for those who need to understand the mechanics, not just the noise. Now, let us look into the collective hallucination of Wall Street, because right now, the institutional money is not just optimistic, they are euphoric. The S&P 500 sits at 6,640 absolute all-time highs. The major banks are tripping over themselves to raise their targets. Barclays has just capitulated to the mania, raising their year-end 2026 target to 7,400. That is 11% upside from here. Morgan Stanley is even more aggressive, painting scenarios near 7,800. UBS is betting on a roar rather than a recession. Why? What do they see that justifies these valuations? They see a trinity of catalysts. First, corporate tax cuts. They believe Trump will slash the rate from 21% to 15%, mechanically boosting profits by 10% overnight. Second, deregulation. They envision a world with fewer environmental rules, weaker labor protections, and zero antitrust enforcement, a paradise for margins. Third, animal spirits. CEO confidence is surging. Buybacks are accelerating. The market is feeding on its own adrenaline. But look closer. Read the footnotes. Every single one of these bullish targets is built on a foundation of glass. Barclays explicitly states their 7,400 target requires no recession and perfect policy execution. Their bear case. If tariffs trigger a downturn, they see the S&P falling to 4,500. That is a 32% crash. Morgan Stanley warns of midterm volatility and negative growth surprises. UBS admits valuations are stretched to historical extremes with price-to-earnings ratios in the low 20s. These are not predictions, they are prayers. They are betting that everything goes perfectly in a world where chaos is the new normal. Independent strategists, the ones not selling you stocks, are screaming warnings. They see the ghost of stagflation inflation from tariffs colliding with recession from trade wars. They know the Federal Reserve is trapped. Cutting rates fuels inflation, raising them deepens the recession. Stocks and bonds will fall together, leaving no place to hide but gold. They put the probability of a catastrophic crash in 2026 at 30% or higher. That is not a tail risk. That is a 1 in 3 chance of ruin. And the market is priced for zero mistakes. Let me walk you through what the crash looks like. I am not guessing. I am using pattern recognition based on how every prior bubble has popped from 1929 to 2008. This is the timeline of the collapse. January to March, 2026. The trap closes. President Trump takes office. He immediately signs executive orders for aggressive tariffs on China, Mexico, and Canada. The markets do not panic, they celebrate. Investors are blinded by the promise of corporate tax cuts. The S&P pushes to 7,200. Bitcoin surges past $120,000. It is pure euphoria. CNBC runs segments about the new American century. Retail investors pile in, chasing the momentum, afraid of missing out. But the smart money is not buying. They are selling. Insiders are cashing out at record speed. The VIX, the fear index, is asleep in the low teens. Everyone thinks it is safe. Nobody sees the iceberg. April to June 2026. The reality check. The bill arrives. China does not just sit there, they retaliate. They impose strangling tariffs on U.S. agriculture and energy. Soybeans, corn, and liquid natural gas exports collapse. Simultaneously, the Treasury Secretary admits that foreign demand for U.S. debt is evaporating. China accelerates its dumping of U.S. treasuries, pushing their holdings below $650 billion. When buyers vanish, yields must rise to attract them. The 10-year Treasury yield spikes. This is the poison. When yields rise, bond prices fall. Pension funds and insurance companies holding trillions in safe government debt are suddenly sitting on massive, unrealized losses. Mortgage rates jump back to 7%. The housing market freezes. First quarter earnings arrive, and they are a bloodbath. Margins are crushed by tariffs. The S&P corrects from 7,200 to 6,200, a 14% haircut. The media calls it a healthy correction. They are wrong. July to September 2026, the credit event. This is when the floor falls out. It starts in the shadows. We hit the maturity wall in commercial real estate, $1.6 trillion of loans coming due in a high-rate environment. A major regional bank, heavily exposed to empty office buildings, fails to refinance and collapses. Panic spreads instantly, but the real explosion happens in the basis trade, a massive, leveraged bet by hedge funds using Treasury futures. As volatility spikes, these funds face margin calls. They're forced to sell everything gold, stocks, Bitcoin just to raise cash. The algorithms smell blood. High-frequency traders front-run the liquidation. The S&P crashes from 6,200 to 5,200 in 3 weeks. Bitcoin plunges from 90,000 to 55,000. The Fed holds an emergency meeting, flooding the system with liquidity. But they cannot cut rates because inflation is still raging at 4%. The liquidity changes nothing. The trust is gone. October to December 2026. The recession. The cascade is now unstoppable. Third quarter earnings are catastrophic. Companies slash guidance and, more importantly, they slash jobs. Unemployment ticks up from 4% to 6%. Consumer confidence collapses. People stop spending. The economy enters a formal recession. The S&P falls to 4,400. Bitcoin bleeds to 35,000. And then, the deficit number for fiscal 2026 leaks $3.2 trillion. The bond vigilantes revolt. 10-year yields hit 6%. The U.S. government is effectively insolvent at these rates. We are now drifting toward the cliff edge of a sovereign debt crisis. January to March 2027, the failed auction. The year begins not with a whimper, but with a siren. The U.S. Treasury attempts to auction $80 billion in 10-year notes to fund the exploding deficit, but the buyers are gone. China has already reduced its holdings to below $500 billion. Japan, fighting its own currency collapse, sells another $100 billion. For the first time in modern history, foreign central banks hold more gold than U.S. treasuries. They have crossed the Rubicon. The auction fails. The bid-to-cover ratio collapses. To prevent a default, the Federal Reserve panics. They announce yield curve control, unlimited money printing to buy the debt that the world refuses to touch. This stabilizes the bond market, but it murders the dollar. The dollar index collapses from 105 to 95 in weeks. Import prices skyrocket. Inflation, which was cooling, reignites to 6%. Real wages are incinerated. The S&P crashes from 4,400 to 3,800. Bitcoin, the risk-on proxy, falls from 35,000 to 23,000. Pension funds are now technically insolvent. State budgets are imploding. The political environment turns toxic. Trump's approval rating is in the 30s. Democrats control the House after a brutal midterm. Washington is gridlocked. Nothing gets done. April to June 2027. The Great Hollow-out. We hit the bottom. The S&P 500 touches 3,400, down 49% from the peak. Bitcoin bottoms at $19,000 and 84% wipeout. Unemployment hits 9%. We are looking at 15 million people out of work. But the numbers don't tell the story. The story is the commercial real estate maturity wall. $587 billion in commercial loans mature in this window, and nobody can refinance. Regional banks fail in clusters. The FDIC is overwhelmed. This is the worst recession since 2008. Perhaps worse because inflation prevents a bailout for the middle class. Credit spreads blow out. Nobody can borrow except the ultra-wealthy. Consumers are maxing out credit cards to buy groceries. Delinquencies spike. Auto repossessions fill stadium parking lots. This is an economic depression for the bottom 50% of Americans. July to December 2027. The zombie economy. Stabilization arrives, but it feels like paralysis. The S&P at 3,400 is finally cheap. Value investors step in. The Fed, having crushed demand, finally cuts rates from 5% to 3%. The bleeding stops. The S&P grinds slowly to 4,200 by year-end. Bitcoin bounces to 30,000, but there is no growth. GDP is flat. Unemployment stays stuck at 8%. The U.S. credit rating is downgraded from AAA to AA. We have survived the crash, but we are left with $43 trillion in debt and a permanently damaged currency. Now, let's focus on the two assets everyone is watching, Bitcoin and gold, because the market treats them as brothers, but in a crash, they are enemies. Right now, Bitcoin is hovering near $97,000. The crypto crowd is convinced it is going to 500,000. They tell you Trump is the crypto president. They tell you a strategic Bitcoin reserve is coming. They tell you institutional adoption is inevitable. And in the short term, they are right. We will likely see Bitcoin spike to $120,000 in early 2026 as the euphoria peaks. But then, the trap snaps shut. Why? Because Bitcoin is not digital gold. Not yet. Data from 2025 shows Bitcoin's correlation with the Nasdaq peaked at 0.91. It is not a safe haven. It is a leveraged beta on the tech sector. When the stock market catches a cold, Bitcoin catches pneumonia. In 2022, the S&P fell 25%, Bitcoin fell 65%. When the liquidity crisis hits in mid-2026, Bitcoin gets obliterated. It crashes from 120,000 to 55,000 in the third quarter. Then, as the recession deepens, it plunges to $19,000 and 84% collapse. Leverage is the killer. Futures, perpetual swaps, options. The entire crypto market is built on borrowed money. When prices fall, margin calls trigger a cascade of forced selling that no support level can withstand. But here is the twist. In late 2027, after the dollar has been crushed and the Fed is printing trillions, Bitcoin becomes interesting again. It bottoms at 19,000 and slowly climbs to 30,000. The narrative shifts. It stops being a tech stock proxy and starts becoming a true hedge against currency debasement. By 2030, it could be back at 100,000, but you have to survive the valley of death to get there. If you hold through the crash, you are financially suicidal. Gold is the winner in this scenario. Currently at $4,050, gold will initially fall to $3,800 during the liquidity event, when hedge funds sell everything just to raise cash. But then, it decouples. While stocks and Bitcoin languish, gold rallies hard. Central banks know this. In the first quarter of 2025 alone, central banks bought 244 tons of gold. China, Poland, India, they are buying record amounts because they are preparing for the death of the dollar. By the end of 2027, gold surges to $4,500, an 11% gain from today. But a massive 20% gain from the panic lows. It is the only asset with no counterparty risk. It does not rely on a CEO, a government, or an internet connection. When the world breaks, gold stands. Now, let's stop looking at charts and talk about human beings. Because market crashes are not abstract lines on a screen. They are extinction events for the middle class. Imagine a 55-year-old worker who has diligently saved $1 million in their 401k. In early 2026, they feel secure. By mid-2027, that balance is $550,000, a 45% loss, 10 years of sacrifice, grinding, and saving vaporized in 18 months. Retirement isn't just delayed, it is canceled. They will work until they die. The housing market becomes a prison. Home prices will fall 20 to 30%. If you bought a house in 2024 for $600,000, it is worth $420,000 in 2027. If you put down anything less than 30%, you are underwater. You cannot sell because you owe the bank more than the house is worth. You are trapped in a mortgage you can no longer afford. And you will need to sell, because unemployment is hitting 9%. That is 15 million Americans out of work. Recent graduates will face a lost decade. Experienced workers in their 50s will get laid off and discover that the job market has no place for them. Families will burn through their savings in months. Currently, credit card debt is already at an all-time high of $1.1 trillion. When the paychecks stop, those balances explode. Delinquencies spike. Cars get repossessed in the middle of the night. Small businesses, the heartbeat of the economy, will suffocate as credit lines are cut and customers vanish. This is the K-shaped apocalypse. The top 1%. They will be fine. In fact, they will be better than fine. They are sitting on cash, waiting to buy your house, your stocks, and your business for pennies on the dollar. The crash accelerates wealth inequality to levels that tear the social fabric apart. We will see political extremism surge on both the left and the right. This is not just a recession, it is a sociological breaking point. Now, let me address the optimistic scenario, because humility is required in forecasting. Maybe I am wrong. Maybe Trump executes a masterclass rather than a disaster. Maybe the tariffs are surgical instruments instead of blunt hammers. Maybe tax cuts ignite legitimate productivity growth without detonating the deficit. It is possible. I place the probability of this Goldilocks outcome at 35% in this world. The S&P 500 climbs to 7,500 by the end of 2026. You make 13% on your money. The crisis is averted. But you must weigh that against the crash scenario. The probability of catastrophe is also roughly 30%, a statistical tie. However, the consequences are not equal. If the crash scenario plays out, the S&P falls to 3,400. You do not lose 13%. You lose 49%. Your Bitcoin position drops 80%. Your purchasing power evaporates. This is what professional traders call asymmetric risk. The upside is a modest hill. The downside is a bottomless cliff. Expected value mathematics demands that you walk away from this table. Yet, most retail investors will stay. They are driven by greed and the fear of missing out on the last 10% of the rally. They believe they can time the exit. They believe someone will ring a bell at the top. They are wrong. When the crash comes, it does not knock. It kicks the door down. Liquidity vanishes instantly. You will try to sell, and you will find no buyers at reasonable prices. You will be trapped in a burning building. You will ride your portfolio down 40%, hold through the denial, and then panic sell at the absolute bottom just in time to miss the recovery. This is the cycle of wealth destruction, and right now, the trap is set. So here is the bottom line. $38 trillion in debt. Annual deficits running at $2.4 trillion. A president promising to fix it all with tariffs that generate a fraction of what is needed. The math simply does not work. Yet, the S&P 500 sits at all-time highs, and Wall Street targets 7,400 based on the assumption that everything goes perfectly. Bitcoin is approaching 100,000, and gold is signaling a fire. The setup is a classic bubble, priced for perfection in a world destined for chaos. We are staring down the barrel of stagflationary tariffs, deficit-exploding tax cuts, and trade wars that strangle growth. The timeline is etched in stone. Early 2026 brings the euphoria, mid-2026 brings the correction, late 2026 brings the crash, and 2027 brings the crisis. The S&P falls to 3,400. Bitcoin collapses to 19,000. The dollar loses 20% of its purchasing power. Unemployment hits 9%. America's global dominance erodes. This is not inevitable. Policy could change. But based on every signal, moderation is not coming. We are getting maximum tariffs, maximum chaos, and maximum leverage. The market believes one man can magically fix decades of structural rot. He cannot. He will likely accelerate it. The crash is coming. The only question left is simple. Will you see it before it happens and protect your family? Or will you believe the hype and ride your portfolio down into the abyss? $38 trillion says the math wins.